Bombardier, the Canadian-listed plane and train maker, is selling its train business to Alstom of France. Superficially, this looks like a good deal and will reportedly result in a cash injection for Bombardier of more than $3 billion. Unfortunately, we don't think that this will be enough to save Bombardier, and we think that it remains in deep trouble, because after the deal it looks to be structurally unprofitable. It has no way to pay down its nearly $8 billion of net liabilities, and there are now very few assets left to sell. In fact, we think that investors should prepare for a crash landing, because Bombardier may actually go into liquidation. But before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. Bombardier is upbeat about the Alstom deal, and their slides talk about building a strong cash position and how they're going to start paying down their debt. The problem is, we think they're glossing over a few of the key issues. First, this is a memorandum of understanding, not a final price. The deal won't close for a year, and Alstom has plenty of opportunity in between now and then to renegotiate the price, depending on what they find out. We've long been critical of Bombardier's accounting, and we worry that Alstom may go through the books and find some rather ugly surprises buried in the accounts. To give you some examples, Bombardier originally used contract accounting to pre-book profits, only to then have to write them off when the rules changed. With the Airbus deal, they magically revalued up their stake, only to have to write it off. They use all sorts of ways to borrow money that avoids going to the bank so that they can obscure their real leverage. Investors should think of this announcement as the start of deal negotiations and not the end. It's worth remembering how Airbus completely renegotiated the C-Series deal when they spotted that Bombardier had such a weak hand. Delaying the deal for a year also means that Bombardier will be spending $1.3 billion in 2020 to cover restructuring provisions, and with bond coupons over 7%, the difference means there's an extra $300 million of interest costs. Adjust for these and the sale price nearly halves. The next problem is that without the train's cash flow, Bombardier will barely cover its cash interest costs and is very far from covering its full financing expense. The deal does simplify Bombardier's profit and loss and balance sheet, but the problem is it becomes structurally unprofitable, and to restore the company to profit it needs to cut debt by another $2 billion and then reissue its bonds at a coupon hopefully below 5%. We think that looks impossible with the current balance sheet. With so little left to sell, we think their only option is to quickly issue $2 billion of equity so that they can refinance their bonds at a more viable interest rate. Problem is, they need to do this quickly before suppliers and clients work out exactly what's going on. But now we are left with two further problems. First, the family controls 50% of the votes via A shares that have 10 times the votes of the B shares, and while $2 billion plus may save the company, it would give the B shareholders a majority, at which point the family would forfeit control and potentially lose their board seats. The second problem is that the company looks very expensive. A standalone private jet business with a clean balance sheet might be worth around $9 billion. Problem is that Bombardier's real EV is already $13 billion and possibly higher given the question marks around the Alstom deal and Bombardier's full liabilities. Equity holders are therefore in a bind. A massive dilution will bail out the bondholders, but could leave them with little equity value unless bankers, government and pensioners can be persuaded to take cents in the dollar. If you'd like to dig into some of the issues we've covered, please visit the Bombardier page on our website using the links below. There you can see some of the questions we think investors should ask, and you can download some of the recent filings where we've highlighted some of the key points. Alternatively, to learn more about our research or to keep up to date with our reviews, subscribe to our channel or send us an email. Before you go, please remember that none of this should be taken as investment advice. We've sourced our facts from the company documents, but the interpretations and conclusions are just our opinion, and of course they are subjective and should not be used as the basis for an investment decision. Thank you very much for your time.